Welcome to the July edition of our Economy Markets and Investments Outlook for this month. And this time, our focus is going to be a lot on the world outside and the outlook for India. So, I'm going to start with focus with what's on top of everybody's mind, right? The coronavirus case. So, on India, let's have a quick status update on this COVID because the one thing that's become certain is that COVID is not going to go away from our life in a hurry, right? Especially our economic lives. Because just as we heard news about India first wave control, the second wave came. Just as we heard news that the Western world was doing very well in controlling, you had the Delta variant, right? So this crisis is something that one has to learn to live with and manage with, right? So let's understand the dimension of this crisis from India's perspective, right? The first thing is that after the second wave, we have now seen a good traction in terms of the number of people cured, the daily cases, all of them coming down. So the second wave has been well managed ultimately by the country. And across states, you can see that the 7-day average of daily cases after peaking has started dropping in all the states, right? So nationwide, the daily cases, as you can see, as latest as June 21, has dropped dramatically, and active cases continue to decline, right? And the decline of the cases, right, is not directly correlated to the vaccination, but the vaccination story across the world, if you see, many countries have reached a tremendous rate per 100 people. India is still way behind on the vaccine story. We're still only 24% of our population effectively that we have administered the dose. But bear in mind, that's also because of the size of our population, right? Now, this vaccination rate, right, we are doing 4.2 million a day, right? That means, post Mr. Modi's announcement, there was a sharp spike and has tapered on, but still it's higher than the pre-Modi announcement period. So we are accelerating our vaccination policy clearly, right? So the total vaccines administered as a percentage of population, as you can see, has been steadily rising. The first dose, both doses, and the total vaccinations, right? Obviously, the both doses is the one which is the slowest graph, and the efficacy of the vaccines. And it's very useful to think about this because in the media, in the stock market commentary, you hear this whole story about vaccines versus COVID cases. Let's remember one thing: the vaccine does not prevent you from getting COVID. I think that has to be clearly understood. Then, what is the use of this vaccine? The vaccine helps tame down the severity of the COVID that you get, which can be seen both in terms of fatalities, that is, people dying from COVID, as well as from the number of hospitalizations, right? So if you take the first wave and the second wave in the comparison, at a time when India was getting 34,000 cases, just for example, the first wave at 34,000 cases per day, we were having 480 deaths per day. Today, at the same 34,000 cases, we are having only 30 deaths per day. So the vaccine is actually what it's doing. It is preventing people from getting so severe a COVID that they die or they need to get hospitalized. So vaccine definitely has an economic positive effect because it allows these people after a week, 10 days of the COVID, and then another maybe 3 to 4 weeks of recuperation and convalescence, you can get back to work. So the vaccine ensures that the impact of COVID, even though COVID may be coming in a lot of people, that it's not a long-term, long-lasting impact. That's why it's important to vaccinate, not to say that we can become COVID-free. That's not a possibility, right? So shifting from the vaccine for India into the GDP, when you look at the quarterly absolute real GDP numbers, the second wave did hit us. But the point was, before the second wave, Indian GDP was on the recovery track. So post first wave, Indian GDP growth was on a good track. And now post the second wave, again, we will see that recovery will come back on track, right? Now, what is happening in this? So how far has been the impact of the second wave and what's the outlook forward? So the first impact, if you take a generic way, is a GST, because today everything is taxed under GST. And you can see that the GST collection dipped in May and June below the 1 lakh crore mark we had set. However, the government's procurement by e-way bills, which also saw a dip in the month of June, saw a rise. So there's a lag effect between the e-way bill and the GST. So the e-way bill fell first, then the GST fell later. Now the e-way bill has risen. So hopefully you will see a revival in GST numbers in July. So that gives you a good signal that the second wave impact has been absorbed in those 2 months. And from July onwards, we are likely to see an uptick, right? The other factor is that unemployment got badly hit in the second wave. And so a rising employment was then curbed and the unemployment started rising. And that is yet to normalize. So in the coming days, we have to yet see that employment generation again comes back on track. So that's a key risk to study. The other thing is that the outlook of the purchase managers, which is the PMI index, both in the manufacturing sector and the services sector, has taken a downturn. Because when the wave came down, obviously they could not know that the wave is going to be covered so sharply. So all of them toned down their expectation of buying raw materials and semi-finished goods. Hence, the PMI came down. However, next month again, as they see this recovery, you will see the PMI probably inch up as the purchase managers realize that the immediate sales of the bounce back post the second wave would take care of all their existing stock at their stores, and so they will need to quickly restart the manufacturing cycle. So I believe that this drop in PMI is a temporary one, reflecting the outlook because of the second wave, right? And then there are other indicators which are already come apparent. You're taking data up to 30th June, which are showing that except for residential real estate, everything else has seen a bottom during the second wave and has started rising. Retail, parks, workplace, transit, grocery, farm, all this mobility related to that. Only residential mobility has been flattish. The good news again is in terms of the vehicle registrations. The 2 months we saw, June already saw a pent up demand. So what was a sharp drop in vehicle registration has already shown a sharp V-shaped recovery. So that's a sign of the good times to come, right? Rail freight has also shown a consistent month-on-month growth over the last 2-3 months, augurs well for the trade sector, and an overall economic activity tracker, right, which fell in the second wave, has shown an uptick. And I've shown a yellow line, which is a GVA. So as you can see, the GVA generally follows the economic tracker. Now, the GVA is a component of the GDP, right? So this what we are likely to see now is when the GVA numbers come out, you're likely to see a drop, but very soon thereafter, you're likely to see a rise, right? So don't get carried away by a negative GVA number which comes in the next month, because that's reflecting the second wave's actual incidence, right? So overall, if you want to put all these things together, Nomura does a very good job of creating a business resumption index. And they've taken 100 for a pre-COVID state last year in February, March. And during the worst COVID hit, it went to 45. And then the recovery from the first wave took it all the way up to 98. So we were very confident that India was back on track. When the second wave again brought it down to 60. But the good news is the recovery from the second wave has again brought it back to 96. So hopefully in the next 2 months, we will see back to 98 and maybe 200 in by Diwali, right? So that's again a good, very good sign. So hence the GDP quarter on quarter GDP growth, while that may show numbers here or there, we believe that for the year, what RBI spoke about a couple of months back of a 9.5%, which was a correction from the 11% expectation earlier, I think that 9.5%, despite the second wave, should remain on track, right? That's our estimate at this point in time, right? And when now the government itself is saying the third wave is certain, what is it that the economy, like I said, the third wave, the number of cases, vaccination cannot control. But what can vaccine do? It can help people get back to work faster. So from that point of view, it is believed that 70% of the population, if you achieve a vaccination level, then the COVID becomes just like a common cold or a measles or a smallpox, which we have actually cured. So we can handle it. People will get COVID. You go through that 1 week of 2 weeks of quarantine and then 3 to 4 weeks of recovery and back on track. That 70% level at this today's rate, if they continued, it would have been 2 years more. But because the government has now sought to increase it, and if they double that rate, we think that will within this calendar year by December, they should be able to achieve. Now, knowing that doubling is not so easy, somewhere in between, we believe that April next year, that is this financial year, we should be able to achieve a 70% population vaccination rate, which means that a third wave, a fourth wave, or a fifth wave, while it may come and affect certain parts of the population, will not affect economic activity so much. So that's the confidence that we need to carry when we look at the future, right? So that vaccination pace, as you can see, the daily vaccine doses, the first dose, second dose, all are on the rise, though yes, slower than expectation, but still on a rise. So that's why I said between November to April is the time frame you need to plan for achieving that 70% rate, right? So that being said, right, we've taken care of the COVID and what the economy is doing. For the future, the fact that there is a huge monetary stimulus from the RBI is a point to note from an economic recovery perspective. That almost 30% RBI has expanded its balance sheet to the extent of 8 lakh crores of liquidity has been pumped in, which has helped economic activity. See, the Indian RBI's monetary stimulus is not like the US Fed stimulus. Fed buys bonds back and just generally releases. RBI does a very directed release to the MSME sector, to the construction sector, to specific sectors to boost economic activity. So RBI actually does what a job of fiscal stimulus should do by directing the liquidity to specific parts of the market. That's why these in India, this monetary policy of RBI is very economy positive, right? So that's where the availability of liquidity will iron out some of the problems from the wave. And along with that, the rate cuts that the RBI has done have also been to some extent in the existing loans, but to a large extent in the new loans has been passed on to the consumer. That means what? That's why you saw vehicle registrations are up, because interest rates on auto loans are at all-time lows. You can get around 7 to 7.25. You can get an auto loan today. Same with a housing loan. So the effect of the RBI through directed liquidity and through rate cutting means that the economy has been given a very soft way to plan for the future recovery. I think that point of view, we must not forget that RBI has an equally important role to play in the recovery from a crisis. Now, based on this immediate short-term outlook for India, which you have summarized, let's just for a minute look at the global COVID state. The reason I say this is the most important. As you will soon see later, these factors, the global factors, far outweigh domestic factors when you talk about the Indian stock market. Not necessarily for the Indian economy, but from the Indian stock market, which is where you and I earn a living. So there, if you see now, and again putting back the chart which I put earlier, right, the share of people who received one dose, very good progress. India is still at the 25% levels, but the rest of the world, bigger countries have achieved 60, 50, 60% of dosages. And especially if you see, many economies have achieved double dosages, also of a very high percentage. Notable are the UAE, the UK, the Israel, the US. Sizable economies have achieved high double vaccination rate. Why I point this out is this means that the impact of a COVID Delta wave, whatever, which I just come to, will be less on the economy. Remember that. It can't prevent the virus from occurring, but the impact of the economy. So definitely the world at large is in a much better prepared state than India to minimize the economic impact of a future wave. So from that point of view, if you see, right, the cases, despite that vaccination percentage, cases after dropping after their third wave, there is a fourth wave developing. The UK, can you see, as a sharp rise. US, France, Germany are also showing these sharp rises. What is the key? The key is that they're also seeing an increase in the hospitalization, right? Why is this happening? This is because the world is being affected by a new variant called the Delta variant. So these vaccines were designed to be very effective against the Alpha variant. Now the virus has mutated itself and created a new, against these vaccines seem to be less effective, but still, right? These kind of variations are the one which you will see that the headline numbers of people getting affected will go up, and which is something the markets will be concerned about in terms of future economic recovery of the world. Yeah, so bear in mind that the Delta variant is something that we need to track. right? So that was the medical part of it. What about the monetary stimulus? We spoke about RBI's monetary stimulus. What about the global monetary stimulus? Like I mentioned, global monetary stimulus is like just taking a hose of water and spraying it all over, right? So the four big countries, US, Europe, Japan, and Britain, have itself pumped $13 trillion into the world, and 29% of the GDP is what they have done. And in the next 2 years, I expected to pump another $29 trillion. So the world has chosen that throwing money at this problem is the best way to solve the problem, because abroad, this kind of a money actually has gone and boosted all kinds of markets because there's no control. Unlike in India, they have not controlled it, saying only for this sector I give liquidity, only for this sector I give softer interest rates. No. So in addition to that, the Indian government did not do much of a fiscal response. As you know, our fiscal response was just 0.8 to 1% of the GDP. But worldwide, that's not the case. Worldwide, from a point 0.2 level before COVID, almost 4% of global GDP has been thrown at the problem. This is important from what perspective? Two perspectives. First is the fiscal stimulus is generally directed towards specific industries like infrastructure, like auto, whatever. So they have a more direct economic impact. But do they have a stock market impact? Like I said, the monetary stimulus has a direct stock market impact. But does a fiscal impulse have a stock market impact? Yes. That's the reason I brought it, because the global fiscal stimulus ultimately will lead to revival of global GDP growth, but also has an impact on the stock markets of the world. How do I say that? When they pump fiscal surplus into fiscal money into the economy, what happens is that all these nations are essentially deficit nations, including the US, all Europe. So when they pump that money, the income is not there in a recession, so their deficit widens. Their fiscal deficit widens, their current account deficit widens. So when that fiscal deficit widens, the country's riskiness increases, right? Rating agencies evaluate that risk. When the riskiness increases, then the country is getting weaker, right? More riskier, hence weaker. So that, where is it reflected? In that currency in which a country trades, right? It's a currency which weakens. So if you take the dollar, for example, a rising fiscal and current account deficit of America leads to a weakening dollar. Now, what happens with the weak dollar? That's where the stock market impact comes in. Because if you take that, there is global monetary liquidity. You take the fact that global interest rates are close to zero, right? That means there is cheap money and plenty of money. Now, where will the person who takes that money, because nobody controls who takes the money, where will he invest the money to make a return? He has a choice of investing in the US, in Europe, or elsewhere. So if he invests in the US, for example, from the US, but the dollar is weakening. So as it is, the US is in a slowdown and the dollar is weakening. So what does the hedge fund do? He borrows the money in America and he puts it against what the dollar is weakening, against other countries' currencies. So what happens is, let's take India, for example. He puts the money in India. So the Indian stock market, right, gives a return based on the outlook. So he gets that return. But on top of it, he gets a return from the appreciating rupee. So that country which is expected to benefit the most from currency impact gets the most inflows. So clearly the stock market benefits from the weak dollar in emerging countries. I'm making this statement. Is that true? Absolutely. So the red line here shows the dollar index. It's called DXY, dollar versus X and Y currencies. I have inverted it so that the directional flow can be seen. So this is the inverted dollar index in red. And what is the blue line? It is the Bloomberg's emerging market capital flow proxy. So it tells you about emerging market flow from advanced countries. So can you see how closely they move together? Whenever the dollar strengthens, which is a drop, the emerging market loses money. Whenever the dollar weakens, which is the rise of the red line, emerging market flows increase. So what I was explaining in theory in the previous slide is there in the practical also, that there is a direct correlation between a weak dollar and a greater flow into emerging markets, right? Now, that flow, obviously the $13 trillion of liquidity has found, part of it has found its way into US stock markets, but Part of it has obviously come elsewhere. Where has it gone? So since March 2020, if you track this number and you take the first line is the financial year to date this year. Okay, leave that for the time being. Then next line tells you April, May, June last year, post COVID. So that's when the liquidity pumping started. But can you see one thing? From there, quarter on quarter till the latest quarter, there's only one country which has got positive flows right through this period, and that's India. So despite the fact that emerging markets should get the flows, other countries haven't got it because their own markets, they're expecting a negative return from their economies and their markets. So though there's a currency appreciation, FIs don't have the guts to put it there. But why didn't they put it in India? Many reasons. First is India's long-term growth outlook, right? Which I've spoken in past webinars. I'll show you a few slides. One, but more importantly, of all these countries, India is the biggest commodity importing country. So what happens in the world is in a slowdown, commodity prices go down. So who is the one who will benefit when commodity prices go down? The one who imports a lot of commodities. So the drop in oil prices during the crisis meant that they felt that Indian companies who are importing oil and oil related derivatives as imports, who does it? Auto companies do it, paint companies do it. So these input costs will come down sharply, their EPS and profit will go up, so the Indian stock market will deliver a good return, right? So the fact of the matter is India's long-term growth story, the fact that India is a crude importing country, and the fact that because of this, the Indian currency will also appreciate because a weak dollar means strong rupee, meant that all three factors worked in India's favor. And so India got a huge share of these flows, right? So naturally, when you then look at this same data, I've put it out in quarter and quarter in colored coding. Don't get into the table, just see the headline. So even as this last month of June, excepting India and a couple of other countries, most emerging market baskets saw only outflows. India was the one which continued to get inflows. So India is still a darling of the FIIs for those three reasons, right? And hence, in a dollar-based perspective, look at it from an FII's angle, an investment in India has delivered the best return of 72% since the March 31 COVID crisis related drop, right? So India is the market which has appreciated the most because this money has come and we pushed up the valuations in a market, right? So that's where I see that Indian stock market, the valuations are trading well above their long-term average. Long-term average is around 18 and a half, and we are trading at 20 today. So Indian equities, especially large caps, which is what the Nifty represents, are actually richly valued, right? Because of these flows. And in fact, because I told you that India got flows much more than any other emerging market, the relative to emerging market, today India's forward PE is trading at a 68% premium. Now, 68% premium, you may say, is it a cause for worry? Yes, if you look at the long-term premium, it's at a record high. The last was we had achieved was back in 2000 level when it was 58. 58% was the premium. Today we are trading at 68%. Why do I point all of this? Because the net result of all these flows is what has happened. This also tells you the story that the forward earnings, right, that the market is expecting is itself high, but the market participants are betting that it can be even higher than expectations. Otherwise, why would you put your money? So that's the story from a foreigner's outlook to India. And domestically, the reason Indian market gave only 71% return, actually it should have given much more, was because all the time the FIIs were buying right from last year's first quarter. Mutual funds were consistently selling because mutual funds were facing redemptions from customers. Also because mutual funds also did not believe that India could recover so fast from the first wave and that India's economic future would not get so damaged. So they were also cautious in that period. Well, FIIs, because they looked at it as there is no alternative to India in buying, the Tina effect, right? So the market's rise was actually curbed by domestic MFs continuously selling. But this quarter, April, May, June. After that, the next quarter, quarter two, which is April, May, June, sorry, calendar quarter two, Indian domestic MF has also turned buyers. What is the reason? First, the return of the mutual fund investor. As you know, since March, mutual fund industry has faced net positive flows. Number one, as you know, SIP flows have also strengthened. But number two, mutual fund managers now realize that in the first wave we recovered, second wave also we will recover. So they have now reinforced their faith on the Indian economy bouncing back quickly from this. In the first wave, they did not understand this and what the impact would be. Now you have the lesson of the first wave. So they are not panicking now and they are buying. So now the combined effect of the FII and the mutual fund buying, because mutual funds don't buy only large caps, mutual funds buy all the cap curve. There is where you're seeing that since March 2020, if you look at the returns and you take 1 year return, which is the most proximate to that, because 3 year means it's before the coronavirus, small cap index has delivered the highest 106%, mid cap 80%, and large cap is delivered only 40% in rupee terms. What you saw 71% was in dollar terms. So now, what explains this? Are mutual funds buying so much that this is going up? It's only partly true. What is happening? It's not only mutual funds which are buying, it's also that since the pandemic, as you have seen, demat accounts have exploded. Lots of first-time investors based on discount brokers like Zerodha have started buying stocks based on tips, and these are typically called Robinhood investors. And naturally, the stocks they buy are more at the small cap and micro cap and smaller end of the mid cap curve. That's one. So mutual funds are being supported by these investors in terms of direct buying. But more importantly, the reason this rise, don't get carried away. Just because this rise is more doesn't mean that more money came into small caps. No, what happens is that in large caps, right, it's a very liquid stock. If I come and buy 10,000 shares, the market price is not going to change because I buy. But if I buy even 1,000 shares of a small cap, the price is going to shoot up. Why do I say this? Because the free float, as the word is used, what is free float? In every small company, right, the promoter owns 50 to 60% of the stock, right? It's his own company, he doesn't like to give it up. Institutions own another 20-25%, big when they come in as a QIP or whatever. It's only the balance 20-25% is available for trade. So there's a very low liquidity in the stock. And so when somebody comes to buy, the prices shoot up. And that's the impact that you're saying, that even a small amount of buying in the small cap and the smaller mid caps has taken them up on a tear. But bear in mind that this can reverse in a similar way. So when a correction happens, even a small amount of selling in the small cap can lead to a sharp correction. That's the nature of the smaller space of the market. But this is the reason what has happened is now being explained this way. And so now when you look at the valuations against long term of the large cap, the mid cap, and the small cap, all of them have shown a V-shaped recovery from March. All of them are well above their long term averages, as you can see. To look at it in actual numbers, I'm comparing now with the previous peak of the market because that was as recent as December 2017 to see what has happened. So can you see that in December 2017, the Nifty was at 18 PE, roughly 17.8. Current forward PE of the Nifty is 26, which means there's an 8.6 increase in the valuation of the Nifty since the previous peak. So arguably, the large cap index is definitely trading at a very rich level. Whether it's overvalued or not is a different issue, but it is definitely richly valued. Whereas a mid cap index still is trading at 1.5 below the previous peak, right? So what it is trading is at 22.5 versus 24. The small cap index is trading at 2.5 higher than the previous peak, right? So that gives you a summary of what I just said. Small caps driven by Robinhood investors plus mutual funds, large caps driven by FIIs, mid caps because they are in the middle. Some FII buying is there, some mutual fund buying is there, but there is far more liquidity in the stock compared to small cap, so they are able to absorb it. Hence, the valuations have not gone through the roof compared to the previous. So today, now when you then look at the inter-se valuation, that is mid cap versus large cap and small cap versus large cap, the table below shows you that today those mid cap and small cap, despite the rise, are trading at a 15% discount to the valuation of the large cap. So what is this indicating? That there is still a value gap, that mid and small cap are not as overvalued or richly valued as the Nifty. So what is the way for the future? This valuation gap, is this going to help us make better returns from mid and small cap, right? So for that, first look at what is the forward expectation for the Nifty, which is being factored in. So the 20 to 23, a 23% CAGR, but it represents actually a huge jump from a 540 of March 21 to 870 in March 2023. So as you can see, foreigners who are putting money into large cap are expecting a very, very sharp rise in the earnings of the large cap company, right? That's why that valuation in their eyes is justified and money is still coming into Indian market, right? But when you now look at the index itself, which is a combination of the EPS growth as well as the valuations, you can see the same story. All three are rising, but this graph doesn't help you understand it clearly. If you now look at the actual index performance, and break up India into good phases and bad phases of economy, right? April 2003 to it was a good, followed by a bad. Then Mr. Modi's government starting was a good. Then December 17, the negativity started until March. And from March on, the markets have been rising. The economy is showing a recovery. So this phase one, phase two, phase three are actually good, bad, good, bad, good. So what this is telling you is that, first of all, is that we are in a good phase now, in a virtuous cycle. The market is predicting a new virtuous economic cycle because it's only been 1.5 years since the cycle started. That's point number one. Already in the cycle, small caps are beating mid caps and mid caps are beating large caps. But what the valuation story is telling you is that there is a gap. Now, when will that gap get filled? When the earnings of mid caps comes better than large caps. When the earnings of small caps come better than mid caps. When will that happen? Only when the economy does better. Because mid and small cap companies are much more closely linked to the domestic economic story, whereas large cap are more linked to world economy plus to the liquidity flows from FIIs. So then you go back to the first table here and see what really happens when a good cycle lasts for a 3 to 5 year period. So 2003 to 8, you saw the Sensex go up 559%. The mid cap index in the same period went up 900%, almost double. And the small cap index went up 1400%, almost triple. So when the Indian economic story actually plays out over the next 3 to 5 years, you will see that the small caps will outperform the mid caps and outperform by wide margin. So that's what the market is predicting, that there is a new virtuous economic cycle happening. Now, is that how good is the probability of that and what is that? We will look at in the coming slides. But from all that I've told you today, it's important that with all these high valuations where the market is, what is the risk? And believe it or not, the biggest risk to the market is actually good news. What good news? Good news on the economy of the world and the economy of the US. Why do I say it? Let me explain to you, right? First of all, you take the COVID infection slope, right? The COVID infection slope, as long as the infection slope is bad, that's bad news, correct? That is rising COVID infection. So what is then good news? A drop in the COVID infection, which will help the economies to recover faster, right? So if COVID gets controlled in the Western world, then the US economy shows strength, which means their GDP growth will grow. Their GDP growth grows, the government's income will grow. So the fiscal deficit will come down and the dollar, instead of weakening, will start to strengthen. I gave you a very long explanation how dollar weakening, emerging market flows diverted to India has helped India. So you can imagine the reversal of that and the dollar strength will mean capital flow back into the US. Number one. From where? From where it went. Where? Emerging markets. Which emerging market? India. So a dollar strength is a clear signal for reversal of capital flows away from the countries where it went. That's number one. Second reason, what happens in a dollar strength is that India, the rupee depreciates. So when the dollar strengthens, India rupee depreciates, what happens? Indian imports become costlier. If Indian becomes costlier, if the domestic economy is not in a recovery mode, that higher import cost of raw materials cannot be passed on to the consumer. So EPSs will start to shrink. So the dollar strength with the rupee depreciation has a negative impact on the Indian EPS also, in addition to flows. Next, when the dollar strengthens, the economy is recovering, it means that the commodities which have been downtrend recently and the uptrend because of China's recovery could sustain that uptrend because of US recovery and the Eurozone's recovery. So if they are then buying commodities, what happens? Two things happen for India. First is India gets commodity inflation. Like I said, oil prices, in addition to a weaker rupee, the oil price itself rising will hurt the Indian EPS, number one. And the oil price rising, if the monsoon turns bad, as you know, the monsoon has so far been good, but it's still yet to play out fully. So that combination could lead to higher inflation for India, imported inflation. This, but more importantly, just go back to the top bubble. This commodity price bubble, if the commodity prices rise, what happens is that there will be reallocation of capital by the FIIs within the emerging markets from commodity importing countries like India to commodity exporting countries like Brazil and Russia, because their economies got hurt in a drop in commodity, but their economies will benefit from a rise in commodity. So an FI is smart. He has no love loss for India or Japan or any country. He will say, where is my return, the valuation, the best bet? So in a rising commodity, money will flow even within the emerging markets away from India into commodity exporting countries. So that's the second risk of a commodity rally. Now, this commodity rally will naturally lead to inflation in the developed world. So in US, if the inflation rises, what is the Fed going to do? Rise interest rates. And second, that most dreaded word, tapering. What is it going to taper? It's going to taper the liquidity, which means it's going to pare back the bond buying. They will start bond selling, which means what? That liquidity will get tightened, and so there'll be less money to come into emerging markets. In fact, whatever money is there because of the higher interest costs will get pulled back because the profit margins have shrunk for the hedge funds. And similarly, for India also, this inflation may force the RBI to shift from its accommodative stance into an inflation fighting stance, which means that they will also pull back liquidity and the rate support. And so this will actually affect India's economic growth through the EPS growth. So this is the risk. So a good news on the US and the world economy is the biggest risk for our stock market. Now, what is the likelihood of that happening, right? So let's turn our focus to the US first, right? So when you look at the market inflation and Fed, I think a lot of this I've already explained. So I'll only go to the relevant slides. First of all, the US was expected to pump in 9 trillion of the 29 trillion of the world. 9 trillion was to be the US alone in the next few years, that is up to 22, right? What the US has done through fiscal deficit, they have done a very smart thing of directly giving two checks, $1,400 and $600 to every US taxpayer in their hand. So naturally, this has led to excess savings, which has found its way to the stock market. But soon, this excess savings is leading to consumption, right? And to expenditure. So I've chosen one index here, which is rise in US hotel occupancies. People are starting to travel both on work and for leisure, which means that that money they are getting, they are beginning to spend. So the US economic recovery is probably on the way. And more importantly, in the downturn, the job losses that happened in America were mostly at the low wage sectors. The middle wage and high wage did not suffer a loss of their jobs. So they had the purchasing power, they got money from the government, so they are ready to spend. So that's what the US economic recovery, they expect this time, that it's be a very sharp V-shaped recovery compared to the previous recessions. And they will bounce back very fast. So that risk is real that we saw in terms of the US recovery. And if you take the market participants have various ways to do metrics to predict the future. So one is called the 5Y index, which is 5 year, 5 year. They study a 5 year trend and predict the next 5 year trend based on that trend. And as you can see from here, the 5Y on inflation, that is CPI, very closely has predicted the past movements of the CPI. And what is it telling us now? It's telling us now that inflation is going to rise, right? So that's the indicator, right? Similarly, a 5Y indicator for oil prices is also reasonably good prediction and is also trending a similar way. And the third is the 5i index for the metal prices. Here there is a bit of disparity in terms of how it approves, but in the recent rise, can you see how closely it has been mimicking it? So the indicators are saying that metal prices, oil prices, and inflation are all slated to rise in the Western world, right? And why is the markets bothered by these rise? Because if you take 2002 to 2006 and 98 to 2001, the previous two cycles, at these rates of inflation is when the Fed tapered, right? So the market is worried that the Fed is going to taper soon. In fact, a poll of market participants says that 45% of the people expect tapering to happen in October, November, December, and another 16% are saying it will happen by the first quarter of next year. Now, what does this mean? This is saying that 60% of the people are saying in the next 6 months taper is going to happen. This is market expectations. But what is the Fed saying? The Fed is saying that this inflation that you are talking about is a temporary, transitory inflation. So all the Fed governors in their comments have been trying to calm the market, saying, we are not worried about the rise in inflation. You market guys are worried. We are not going to start taper. If the Fed is reassuring the market, so the market is continuing to rise because they're saying Fed is saying. So finally, what matters the Fed? Because what the Fed is saying is that, look, yes, we agree that inflation is short term, but the dotted line tells you what we expect. The Fed's expectation is that inflation will fall. Now, how far the Fed's current view is that, hence the market are calmed because Fed is saying, I'm not going to taper immediately. So the market is calm. But tell me, can the Fed ignore the real data of a US economic recovery when it comes? No. So the Fed is talking based on the data they have on hand. But if you read the tea leaves, it's a matter of time before the US actually economy recovers, at which time the Fed will have no hesitation in reversing its stance and talk about tapering. Now that's data driven. So you or I cannot predict when it will happen, but it's not a matter of if, it's only a matter of when. Is it as per market going to be in the next 6 months, or is it going to be 2 years from now, which the Fed is saying? So somewhere in between, I believe this tapering story will come, and that's the risk to the Indian markets, right? So overall, if you see, the other thing which has been supporting the stock markets world over is that corporate earnings, because of the low interest cost, they've all brought down their debt, has also shown a beat to expectations all over. In fact, India is one of those where the beat to expectation is not up to the global average. India is still also beating. Only Hong Kong has been an earnings downgrade, right? India is also beating, but most other countries have shown much sharper rises, especially commodity countries like Brazil and Russia and Australia have shown a huge jump, right? And so, from a stock market perspective, however, despite Indian earnings not being so much beat, Indian is 13% rise in this market in this year to date, which is at par with the global rise. So despite our earnings not going up, the future story of India is what has been driving our markets return. In fact, if you now look at a 2 year forward, so far we talked about forward P is all 1 year. If you look at 2 year forward PV, then the US and India and Australia are the ones where the expectation that the earnings growth would increase even more in the second year is strongly driving the flows, right? So, in fact, this expectation of a strong future growth means that today, long-term EPS forecasts of the US are far higher than even during the internet boom of 99 2000. That's what we want to show you here. The market is expecting a very strong recovery in the US economy and in the US stock market companies in terms of their EPS, right? And the point of why the Fed is actually not worrying about the inflation is because, as I said, that $2,000 income to each taxpayer has seen retail sales grow up, the blue line. But wages haven't gone up. That's what the Fed is saying. The Fed is saying wages are not. Now, why has this happened? This has happened because all the companies had enough stock of goods to cater to this sale. So they didn't need to start their factories and hire people to manufacture goods. So today Fed is saying, let's wait for the wages to rise. That will tell me that the growth is really on the good wicket. That's what I said. I said Fed is just waiting for this indicator to go up before they change their mind about when they are going to taper. So let's wait and see for that as the biggest risk to the Indian market, right? So, and overall, to summarize this world stock market situation, right, there is something called a bull and bear indicator, which I want to share with you. So this bull and bear indicator, which is composed about 5 or 6 indicators going into it, has a number to it. So when the number crosses 8, it is extreme bull phase, which means you should sell. The market is headed for a downturn. And when it is below 2, it means extreme bad, which means you buy, you will not lose at all. So this is the range of the market, right? Below 2 to above 8. Where is the market today? It's at 6.4. Where was it before the COVID crisis? At 7.2. So one way of saying is that the market is actually less bullish today than it was before COVID hit the world, right? And the 8 number is still some way away. So while the market is reasonably valued, global markets, right, it's still not at a sell-off territory, is a comfort. So how is this indicator bull bear calculated? It takes basically 1, 2, 3, 4, 5, 6 indicators, puts them together, which is the HF, is the hedge fund positioning. Second is the credit market technical. What is the spread for a default grade versus the non-default grade? The equity market breadth, how many stocks are rising, right, across the market, or how many are falling? Then equity flows, are they continuing on a month-on-month rising trend, and flows into bond market. So all of these indicators are just about at 50-60% on the bullish side, just about bullish. It's the long only, LO is long only funds position, a mutual fund like, who buy and hold, unlike a hedge fund which trades in and out. That's at 94%. So long only, which is coming because of the extremely sharp V-shaped recovery everybody is expecting from the economies and the world, is what is trying to pull this towards that valuation of very bullish. But the other indicators are still holding it back. And when they also start rising is when the markets will get into a definite sell territory, as we saw in the previous slide, right? So to summarize, what are the factors that we need to worry about? For India, commodities is the biggest risk, because if oil prices rise and if metal prices continue to rise, India's import bills will rise, and that's what is going to hurt EPS and our markets. One. Second biggest thing is the Fed. All other risks are much less. So keep your eyes on these two indicators, oil and metal commodity prices and the Fed's tapering, for deciding on what to do in the market, right? So on oil, however, we believe that there is good news on hand, because for the OPEC, we know the OPEC, there's been fight between Saudi Arabia and the UAE and Iraq and then Iran. But if you look at the overall numbers, right, oil price for break even for OPEC is $75 billion. So they will try to keep it at 75 to make money, right? But US, its shale is at $60 billion. So US will say, I don't care even if it drops to 62, I still make $2 per barrel. And at some places in the US, as low as $45 per barrel. So there is this fight going on between the two in terms of oil price, because the US wants to produce more at these levels so they make huge amount of money. And Iran supply will come. And when that supply comes, the price will drop. So this multiple factors at play is what we believe that the oil risk is contained. It's not going to rise. The same numbers I've just summarized in a slide, I'm showing you by the graph, right? OPEC's surplus production capacity is coming down, right? Iran oil exports are rising and expected to rise toward the rest of the year. And US break-even price, like in back-end crude oil, has come down to $45, which means that they will keep on supplying. There is no price. Whereas OPEC, if the price goes below 75 to 73, they will cut supply to keep the price above. So it's a fight between the US on the one side and the OPEC on the other side, right? So that's the one I wanted to say. The other thing is, one important thing to remember is, while inflation has a negative impact in terms of the liquidity flows, and inflation has a negative impact in terms of the commodity prices, right? And maybe an RBI's outlook, but actual evidence shows you that when inflation rises after a fall, right, corporate profits actually shoot up, right? Because why is inflation rising? Because demand is rising. When demand is rising, corporates find that any input cost price they can easily pass on. In fact, they keep a cushion and pass it on. So actually, if you see a rising inflation, the counter to what I said is that corporate EPS could actually show a rise and hence counter the valuation correction. So please remember that as an interesting factor to track, right? And apart from this, I talked about India getting so much money and why we're getting so much money. I spoke about it in the last webinar also, in fact, number of webinars. So I will only focus on this slide. I have all the explanatory slides, which I'm going to skip. Is that there are three long-term structural positives: housing, driven by government's other housing policy, driven by lowest ever interest rates around 7%, and driven by the fact that actual incomes of middle class and upper middle class haven't suffered in the pandemic. So housing is going to see a structural boom for many years, and housing has a multiplier effect because cement, steel, PVC pipes, sanitary ware, tiles, electrical wiring, copper, aluminum, paint, woodwork, all of these industries, cement, steel, all get a boost. So it's a multiplier effect. Second is the PLI. What is the PLI? Production Linked Incentive. What is the scheme? It's a substitution of the Make in India scheme. What does it do? It's identified about 20 sectors where the government says anybody who sets up a new plant, foreigner especially, we'll give him 5 to 6% per year incentive of the sales, the value added sales that he does, in order to make sure that he doesn't look at the short-term losses and looks at a long-term investment in India. And this is largely directed at export out of India of what comes out, or import substitution. Why this has come up? It's come up because there's a huge opportunity for India because of a surplus labor, and because the main competitor, the leader in this, China, has faced problems of aging population and reducing working age population, plus a negative outlook because of the COVID crisis of foreigners. So a China plus one strategy is developing in a lot of MNCs, and India wants to capitalize on that. So the PLI scheme is essentially meant to support India's export story, but the immediate impact of the PLI scheme will be in capex, because every factory that needs to be cement set up needs cement, steel, capital goods, and all of that. So the PLI scheme is going to have a short-term impact on the capital goods and the building material space, but a longer term, it will boost our exports. So that's the PLI scheme. The third is the NIP, which is the National Infrastructure Pipeline. As you know, this government has been focused on roads, railways, urban metro, ports, airports, and all of that. Why? To invite foreign capital, we have to get our infrastructure in place. A foreigner doesn't want to put capital and wait for 6 days to reach the port from wherever he's manufacturing, right? He wants super fast highways to go to either to export it through planes or through ships or through. So from that point of view, the NIP, where 111 lakh crores the government is allocating, not just its own money, but inviting FDI into it. And as you know, FDI money, you would have read the news reports, have reached an all-time high of $81 billion in the previous financial year. So all these three are positive for the infrastructure story of India, so the long-term growth of our country. And that's the reason long-term FII money has continued to come to India. And that is one support, because the long-term FII money will not get affected so much by tapering, right? So this now, these three are in fact, now I'm going to skip these things because I just explained all of that to you in the last 2 minutes, is now supported by the fact that the private sector has started investing in capex, because they're all seeing that the V-shaped recovery is happening, and they feel that it takes 2-3 years to really build up capacity. So building for the future, the private sector, the government took a dip because Mr. Modi took away 35,000 crores towards the vaccination story. So the government's budgetary mathematics has gone into a fix. So naturally government capex in the second wave has suffered, but private, the yellow line, has picked up pace, right? And more importantly, it's the construction sector where the effect of this is clearly visible. So factories are being set up, and ministry's capex is the what has led to that. Lockdown has led to that restriction. So overall, this export recovery is what is driving this thing, because domestic demand may take time to come, but people are able to export because of the situation. And so there, when you see the manufacturing capacity utilization is actually going up despite the second wave down in India. And in fact, over the next few months, see the number of announcements in the oil and gas, autos, steel, cement, power, irrigation, roadways, and consumer, the amount of capex announcement. When all of this gets implemented, the order books of mid and small cap companies will rise, and then they will execute the order, the incomes will go up. So the infrastructure cycle is well and truly set to come up. Bear in mind that these are announcements. They will take time to get approval, get bank loan sanction, place the orders, and do that. But this will be a sustained 3 to 5, 7-year story for India, that the capex story is turning around. So on that basis, right, let me now come to the concluding portion of how do you allocate assets in this scenario. I pointed out the fact that the India is recovering from the second wave. There's a third wave risk, but there's also a vaccination story, which is a good news. But at the same time, India has been the favorable beneficiary of a large amount of capital inflows in the FPI sector. And because of that, any good news on the world economy in the reverse of capital, India will face that risk. So as an aggressive investor, what should you do? First of all, of course, you must have a longer term outlook. The short term is going to be volatile. So how do you then allocate? So the first thing I want to focus on is that mid cap has to be your largest allocation, because it's also at a discount to the large cap, and mid cap companies have enough liquidity to absorb, so that the downturn of withdrawal of liquidity will not lead to that much fall, but the rise because of the order books will do. So a combination of value plus the good growth outlook means mid cap is the sweet spot today, right? 30%. Right. Given the riskiness at this point of time, you should not ignore the long-term story, but small caps are richly valued. But despite the correction which would happen longer term, the domestic economy recovery plays very much into small cap. So don't ignore it. Keep a 10% allocation to small cap and a 10% to infra, right? Now, the infra story I spoke about, but like I said, you need to give it time. So today I would keep the allocation at 10% each to the small cap and infra. Actually put together, they will make your allocation a little more, because infra has mostly small caps and small caps are mostly infra stocks. So there's an overlap there, right? Now, then moving up here, is I'm talking about, since you're aggressive investor, to look at the sectors, and what are the sectors which are definitely going to benefit? Banking, because banks have so much liquidity, banks have so much soft money, and banks are now in a much better position to lend, because they have used the easy money to create provisions for the NPA because of the second wave and all of that, and are in a much better balance sheet shape. So banks, according to me, are in a sweet spot, because any recovery of the Indian economy has to be supported by finance from the banks. The other sector where you should look at is IT. Why do I look at IT? For two reasons. IT, because the world in the pandemic has had a fundamental reset of the way it looks at IT, from every manufacturing, every user economy. They work from home, the Internet of Things, the whole this thing around the fact that cloud computing, you got to shift. So your basic IT infrastructure has to be revamped. So all IT companies, large, mid, and small, are going to benefit from a very good order book. Why am I not putting a much higher allocation? Because the market has discounted this. But still, I believe it's a story which will play out. And so it's important to be invested in that IT sector. The second thing favoring the IT sector is that the rupee, if the dollar strengthening is my big story, the rupee weakening is the parallel story. And the rupee weakening means that IT as an export-oriented sector will benefit, right? So this rupee weakening is also the reason I'm going up to the top right and saying that for an aggressive investor, you have to now look at putting as much as 20% of your total portfolio into a globally diversified international. Why am I saying this? First thing is obviously the case for in a diversified portfolio of international equity is the currency story, right? As I said, now because of the strong FPI flows and the strong FDI flows, Indian currency 1 year has actually appreciated by 3.4%. But over a 10-year period, it has weakened by 4.9%. Now, what is the story going to be? Indian currency has to always weaken on a long-term basis. That is what this table is telling you. And you look at the lower table, it tells you the story of why it has to weaken. Because essentially, the difference in the risk-free interest rate, which is the government's borrowing rate between the two countries, tells you the long-term direction of the currency. So US interest rates are at 1.5 today and at 6% in India, means the difference is 4.5. Take quarter upon quarter, it's always at 4.5 to 5.5. So what this tells you is that unless the rupee weakens by 5%, somebody can make arbitrage free money as a profit. Markets will never allow that. So longer term story, and which is what your 10-year is telling you with a 4.9 depreciation, which means that the recent appreciation of the rupee is a correction, like stock market, like correction in the currency. Hence, the rupee over the next few years has to weaken, which means you're buying low, selling high. So that's the reason that export-oriented sectors like IT will benefit, and any mutual fund will invest outside India, that NAV will show the appreciation of this due to the depreciation of the rupee. So the case for IT and the case for exports comes from this. The second thing is that when the US the hikes the interest rates, India will have no choice but to weaken our currency. Right? We have a $600 billion chest, but why would we want to weaken our currency? because of the fact that we want to support our exports. Can India have a strong currency and then suffer exports to Taiwan, Bangladesh, and other competitors? No. So the RBI also will change its stance of deciding what's the correct level of the rupee and allow a gradual weakening of the rupee. And I think it's a matter of time before the rupee breaches the 80 mark in a matter of 3 to 4 years. So from that point of view, I believe that there are the factors in place for a rupee to weaken. And so global funds and export oriented sectors are the ones to benefit. So that's why I've included that allocation, right? And further, I talked about global diversification. Not only you will get benefit from the weakening rupee, you will get a benefit from the global growth, which is overall also growing fast. So countries across the world are going to be growing, and so their EPS growth and their stock markets will deliver good returns, which will add to the currency effect, right? In fact, if you look at the developed country growth, right, it's actually financed by emerging market exports. And emerging markets exports has a correlation with emerging markets capital creation. Naturally, right? You've got to create the capacity to export. So emerging market capital creation means that what? It means that there's a wide-ranging, broad market rally which can happen across the world in both advanced countries, demand-driven, and emerging markets by supply side. So investing in a diversified portfolio will get you good real returns plus the currency which I already spoke about, right? And by diversifying across the emerging market and the world, what happens even if the tapering happens, this time we believe that the impact, unlike in 2008 when the last tapering occurred, current account surpluses of the overall emerging markets are at much higher levels. So they have an ability to absorb a sudden liquidity come currency hit on account of tapering, and hence the health of their economies will also not suffer so much because of the tapering, right? So all of this makes sense then to have a good quantity of international to your portfolio. Switching to a more moderate investor, I would still keep the international, because international is your hedge against tapering, right? It's your hedge against dollar weakening, rupee weakening, right? So keep the international allocation for a moderate risk, but I've taken out the sectoral allocation. Where do I want to put it? I want to put 30% in the balanced advantage. Why? Because ideally you should go that much in debt. But why put in debt and lock your money for 3 years? And debt as an investment today, longer term debt is not a good investment because interest rates are slated to rise. So balance advantage funds, by the fund manager allocating to debt and then shifting out earlier because he's not subject to tax, means that he can play the debt part of it and the equity part of it according to your needs. So BAF is a good category to put 30% for a moderate investor. And then the equity allocation, I would say to put more into flexi cap, multi cap. So I'm not recommending direct investment into mid cap, small caps, but rather choose a flexi cap and multi cap, because all of this, longer term mid caps will, small caps will deliver. In the shorter term, large caps will give you support. So a 30% allocation means the fund manager will play it in your way, and a multi cap means that you're assured of getting 25% in small cap, 25% in mid cap. So which means regardless of what the fund manager thinks, you are going to be present in the entire breadth of the Indian economy through a multi cap fund. So choose multi cap or flexi cap as your interest is. And then the domestic large cap, I would still say keep 20%, because at the end of the day, the liquidity is there to absorb any big selling, because there are other buyers which will step in. So this is how I would like a moderate risk return investors asset allocation to be at this point in time. What if he's a very conservative person? A conservative person, he should ideally shift to debt completely, because the times ahead are going to be volatile. But like I said, instead of doing that, you can either choose a balance advantage, or I would say a better option is to choose an equity savings fund for a conservative investor. Because what an equity savings fund is like, out of multi cap versus flexi cap. Equity savings, you're guaranteed to get equity taxation. You're guaranteed to get 30% in debt, 30% in arbitrage, 30% in equity. So the arbitrage plus debt gives you the cushion against the fall, and the equity will try and give you an additional return. So instead of shifting into a debt, which is the ideal for a conservative investor today, I would say switch to equity savings funds, which are a much more tax efficient way of having a low volatility exposure. All of you are aware, so I'm not going to take this in greater detail, right? Just to let you know that the taxation change, right, actually makes it one of the most efficient instruments across for a person who wants a kind of relatively stable and steady kind of a return. In fact, if you look at it, purely assuming that the debt fund and the equity saving fund gives the same return, which means that the 30% debt component gives the same return, arbitrage gives more or less like debt, and equities will give you a little bit of help. If you take the same return, you're making 150 basis points per year difference because of the favorable taxation, right? So if it's the rate of return, if you look at it, right, in terms of the fact that you're making 5.16 post tax versus 6.72, you can argue that equity savings are the best for a conservative investor. In fact, our equity savings fund, right, which we launched a couple of years ago, last 1 year has given 16% and over 2 years has given 7%, right? So clearly on a post-tax basis, this is going to be even better than any debt fund, right? So with that few thoughts in mind in terms of aggressive, moderate and conservative investor, I close my webinar for the day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.